All right, thank you very much. Thank you for inviting me to Santiago. Well, enough whining about that. So I will discuss this paper here by Andrea Fabiani and co-authors. And so, let me just see. Okay. So in general, this paper here, it estimates the effect of capital controls and reserve requirements and whether that amplify the effect of interest rate policy. The paper says monetary policy, but just to, it looks at the interest rates, right? You could say that the reserve requirements are monetary policy too. Anyway, it's a very nice empirical paper, and it's a very rich data set. So in a very short amount of time, I would focus on the nerdy stuff about regression specifications. I mean, I'm more of an econometrician. I assume that's probably my comparative advantage. So that's what I'm going to focus on. So the first econometric issue is that worries me a lot is that's a lot of conclusions derived from, in reality, 5 observations, right? There are 5 quarters after these constraints are imposed. So we just look at the simple OLS. Regression, right? If you regress a YIT on an XT, and the standard OLS formula is just like that, right? But the I sums out. So you're de facto running T dimension T, which is 5-year regression on these Ys that are averaged over firms. So that's something that to keep in the back of your mind, because it's surprisingly high statistical significance. So I'm gonna discuss that point in some detail. So now there's nothing about OLS that says we can't repeat the observations, right? So by the law of large numbers, this averaging over the Y that implicitly happens when we are regressing on a time varying, only time varying variable gives us the average of Y. If the errors are independent, right, then Y is the true observation plus some independent error, then by law of large numbers, we should see these average Ys being exactly on a line, which you could check by plotting it. But of course, that independence assumption is very shaky, right? And the authors do acknowledge that implicitly by using clustered standard errors. Of course, maybe we should cluster for or cross everything, but what sort of reasonable is to cluster by firm and by bank, right? So you would assume we have 2 parties, there's some shock, some noise, whatever, at the firm level and at the bank level. But that's not what the authors do. They assume that the shocks in bank lending to one industry is independent of the shocks to bank lending to another industry. And that worries me a bit. There's a somewhat weak argument, I think, that there's some rule of thumb, but people sort of at least used to misunderstand about clustering, right? As you need the number of clusters to go to infinity. So there's a rule of thumb, about 50, right? But I mean, that's just a rule of thumb. So I'm usually happy if I have 40 clusters. And there are 40 banks here, so that's really what you should do. And I don't know what's going to happen to the standard errors, but at the very least show the clustering by bank. And I would actually argue that that's the only thing you should show. But in any event, if you don't like that, there are many other ways, right? We don't have to push a button instead of this as clustering. We can model the correlation parametrically at only a cost of a few degrees of freedom, even though people are lately quite reluctant to do that. Alternatively, you could just aggregate out and over the bank level. There are various ways of attacking this problem. So of course, you're not really running a regression with an XT, right? So you have a bunch of controls. So if you have a bunch of IT controls, then by the Frisch-Ward theorem, your regressor is really the residuals from regressing on all those controls. So these controls play a big role, but that they're not really discussed. It just seems like, oh, we're throwing the kitchen sink here to control, but I mean, that's really gives you a lot of the identification. So I think that's not something that's just, all right, we have some controls. So in any event, the core of the regression takes the form, the loans from firm, bank, and PRT, some controls. There's a beta 1 times this interest rate and a beta 2 times this interest rate post, right? So, so efficiency of monetary policy means that when the interest rate goes up, the loans go down. The way that it's done here, right? We could do beta 1 times pre and beta 2 times post, but here the effect post is beta 1 plus beta 2. And another little technical point is the interest rate is lag one period, which sort of seems to be to make the reader believe it's predetermined, but these are really slow varying variables, right? So it's not like it, I believe, make any difference. But certainly for a slow moving variable, you're not going to be able to argue that IT minus 1 is somehow predetermined. So in any event, it's strange to me that in many or most specifications, beta 1 is positive, right? So before these tightenings, you increase the interest rate, the borrowing goes up. And of course, that must be due to omitted variables. But then, do these omitted variables mysteriously disappear? And can we ignore this? I mean, sometimes we can't quite understand the whole picture, and we say, well, you know, this is a difference in difference, and we certainly can see the effect, but that's really something that isn't discussed very much. So if you want, you know, to believe that the beta 2, discuss what happened with beta 1, right? And it worries me a little bit in most specification. If you did do pre-post, I mean, the post value would be the beta 1 plus beta 2 that you are estimating. So this is what they had here, right? And they're basically always insignificant from 0. So in some sense, what your regressions say is that there's no effect of monetary policy if I take it literally after these tightenings. But there was a reverse effect before. So yeah, the reverse effect had gone away, but is that fully convincing? I don't know. I certainly think that that should be discussed a lot more, because before we get to the potential mechanism. So that, I guess, is the most important point. So you look at the mechanism. So you do a regression on bank lending over time as a function of the FX funds, the amount of foreign exchange funds times the interest rate spread to the US. But a little, if this is a mechanism for the previous variable, why change to the spread? But okay, I don't think it matters. We have the same pattern as before, with, you know, reverse effect before of what we would expect and negative after. So now, if you do a simple regression, y equal beta times xz, and then you say, whoa, now I'm showing you the effect of z on the effect of x. It's like, oh, okay, but why is not the effect of x on the effect of z, right? Never capture the value of x funds for a given rate of interest rate. These interest rates aren't moving very much. I don't know or even think that's happening, but now, of course, one bank level FX funds are not going to move an aggregate variable, but there's an aggregate component to these FX funds. And in general, I'll go down here, right? And if in a panel variable, you can think of any XIT variable as the sum of an aggregate component and an idiosyncratic component. And for what you're doing here, for a lot of it, I would like to know what's driven by the aggregate component, what's driven by the time variation in aggregate foreign exchange holdings, and what's driven by differences between the banks, right? It's more convincing if it's driven by the difference between banks, because that's where you really have a lot of variation, right? And well, it's driven by the 5, 6, whatever the whole sample is, 11 quarters or whatever, then it's a different interpretation, and maybe you word a bit more. So oftentimes when people do some regressions, they have a whole bunch of fixed effects, right? To take care of like patterns and FX1s, for example. But they don't subtract these fixed effects before they interact. So all these things that are pulled out implicitly from the main term is not pulled out before you interact. So, and anyway, I have a paper about that. It's quite simple, but it points out a bunch of things that is often ignored. Anyway, so overall, are these FX funds randomly assigned to banks? It is kind of implicit assumption. If we forget about the whichever effect which one, so I would think that here you'll be much safer if you use some predetermined variables, the average over the sample of these FX funds. Some banks tend to have high FX funds, tend to have low, or even better, the start of the sample. That might be a trade-off, right? The safest is, in some sense, to take the start of the sample. That's sort of predetermined. But of course, if they change too much during the sample period, you might throw the baby out with the bathwater. But again, I mean, here's an issue that you might want to worry about. So in any event, it seems like you changed this since you wrote the paper, because I was very, it seems you might not any longer use delta I and delta 2I in the controls, because that really worries me. So I mean, if the whole issue is about the effect of interest rates and tossing in the change in the interest rates, that worries me. Now, the logic of the whole thing is it's really about the effect of efficiency of monetary policy is what it's called, right? That should be about, I would think, the change in interest rates, pre or post tightening. I mean, if I is stationary, like some variable that pops up and down, right? Not have to be exactly white noise, but look a bit like that. Of course, then we want I, right? I is moving about, but clearly from the picture, it's not. So shouldn't it be the changes? Now, in the new version, which I had like between 5 and 10 seconds to absorb, you actually did show results for the changes. And you got very similar coefficients, which was kind of argued was a good thing. But to me, it's actually quite worrisome. Delta I is totally different variable than I. Does it mean that the effect is all directly caused by all your controls? Or another thing that worries me, if people take differences, two-period differences, and you have a break, right? This is about pre or post. So if this delta 2 have one foot in pre, another foot in post, that's a weird change in interest rate. You want to change, you argue you're doing a change in interest rates after, right? So you really should leave out, if you use delta 2, for example, the changes that spans across the change, if you want to ask my opinion. Anyway, so
Ben, you have a couple of minutes left.
How many?
A couple.
A couple. Okay, good. Well, I don't need so much more, I guess. All right. So there are many interactions. So sometimes get a little hard to interpret. Anyway, it's another thing that worries me a little bit. It seems not really being very explicit that you have a foreign exchange normalized by assets. You don't show a lot. For example, I don't think it shows about variation in assets, right? If there's more variation in assets than the variation bank level assets and in foreign exchange holding, then your coefficient is being driven by your denominator, not by your numerator as you interpret it. Probably not the case. Usually assets don't change too much, but I don't know how much of FX changes. So usually it's recommended to use the average initial assets to take the scale out. Anyway, banks with more deposits affecting more post-tightenings, and they correlate it with FX. There's only one tightening, right? So I really would like to see correlation matrices. In the olden days, people always put in correlation matrices. Now, if you do have a lot of fixed effects, you probably should, pull the effect of these bank-specific, whatever average is, right? A fixed effect is just implicitly pulling out these averages, pull them out and then show the correlation. Are these really different variables or not? I don't know. You have a horse rate where you say, well, is it FX that matters? So it's a currency restriction, or is it the reserve requirement? So you split it up in FX, savings deposit, checking deposit. Again, going back to the correlation, if savings deposits and checking deposits are highly correlated, an OLS coefficient is only determined by whatever is orthogonal to the rest of the regression. So in some sense, if these deposit levels are very correlated to it, you're sort of killing them by doing that split. Why don't you do the whole thing? Stronger lending contractions to risky firms. So sometimes, usually the first thing comes to mind is put in some variable like, say, non-linear term in riskiness or whatever. But all the fixed effects, all the control effects are having different effects on each group because you split it up and run 4 regressions. Is that reasonable? Is it not reasonable? I don't know. Again, it would be nice to see. So anyway, so I almost made it on time. Interesting paper. Switch data, although some of the results are current, I think maybe a bit hard to interpret. I would focus on somewhat different types of robustness tests as outlined here. A bit overwhelming number of numbers. So as with this, with that, it's maybe we learn from that, but then that should be pointed more out. Otherwise, you should focus on which are the right ones, I think. And it would have helped me if there was a little bit more theoretical background. I'm a big fan of little toy models. So this is simple, that's linearize the world or whatever. So, but here's the interpretation of what, and sometimes it actually do help you. So, so that's it. Thank you very much.